All right, so today we're going to try and unravel a real head scratcher in the tech world. We're talking about UiPath, a company that's right at the center of the whole AI boom. But at the same time, it's sending out some seriously confusing, contradictory signals.
It's like a tale of two companies. On one side, you have all this incredible hype. UiPath is a big deal in agentic AI, which is basically AI smart enough to do complex jobs all by itself. They're making a profit, they're teaming up with the biggest names in tech, and they just got added to a major stock index. But then you look a little closer and whoa, you see this dark cloud of lawsuits, slowing growth, massive competition, and maybe the most confusing part, the CEO is selling his own stock. So what on earth is actually going on here?
So let's start with the good stuff, right? Let's unpack this side of the story that had investors so optimistic. And, it's pretty easy to see why. I mean, just a little while ago, the buzz was deafening. They get added to the S&P Midcap 400, which is a big stamp of legitimacy. They finally hit GAAP profitability, which for any tech company is a huge, huge milestone. They're launching cool new AI products, and they're linking arms with the absolute titans of the industry: OpenAI, NVIDIA, Microsoft, Google. On paper, this company looks unstoppable. And it wasn't just talk. The numbers were there to back it all up. In their third quarter, they pulled in $411 million in revenue. And that wasn't just good, it smashed what the analysts were predicting. And get this, it wasn't just some fluke quarter. That number represents a solid 16% jump from the year before. That's the kind of healthy, consistent growth that investors absolutely love to see. This next number really speaks to the stability of their business. Their annualized renewal rate, or ARR, is sitting at nearly $1.8 billion. Now, what's ARR? Well, think of it as the predictable, recurring money they get from all their subscribers. A high number like that tells you they've got a really sticky product and a loyal customer base. Okay, so everything looks great, right? A perfect picture. But this is where the story takes a turn. Because when you start digging just a little bit beneath that shiny surface, you start to find some pretty serious cracks. You can really trace the trouble back to 2024. That's when things started getting messy. First, you've got these class action lawsuits popping up, basically accusing the company of not being straight with its investors. Then, bam, in May, they slashed their own revenue forecast. That's a huge red flag, and it absolutely hammered the stock, totally crushing investor confidence. And these legal headaches, they are far from over. And this chart, wow, this chart really tells a story. Look at this. Back in 2021, around their IPO, they were growing at a mind-blowing 80%. Just explosive growth. Now, we're looking at just over 9%. That's not just a slowdown. That's like slamming on the brakes. For a company that's supposed to be a growth story, that is a massive, massive concern. Now, to be fair, in their main sandbox, robotic process automation, UiPath is still the king of the castle. They have a commanding 57% of the market. But you gotta look at who's knocking on the door in that number 2 spot. Yep, you guessed it, big tech. This is the classic David versus Goliath problem. You've got giants like Microsoft and Salesforce breathing down their necks. And they're not just building a competing product, they're bundling their own tools, like Microsoft's Power Automate, right into the software that millions of businesses already use every single day. How do you compete with that? It's like trying to sell bottled water when it's already coming out of everyone's faucet for free. And all of that, the lawsuits, the slowing growth, the competition, it all brings us to the real heart of the paradox here, the central mystery. And it's all about what the CEO himself is doing. Take a look at this. It's not a one-time thing. It's a pattern, a rhythm. This past January, the CEO and founder, Daniel Deans, started selling shares, and he kept selling. On the 9th, he sold 45,000 shares. 3 days later, another 45,000. The 14th, another 45,000. It's this steady, constant drip of selling from the one person who should be the company's #1 believer. It just feels off.
Now, it's important to know this is all perfectly legal. He's using something called a Rule 10b5-1 plan. It's basically a way for insiders to schedule their sales way in advance so they can't be accused of trading on secret info. So he's not breaking any rules. But that's not really the point, is it? The real question is why? Why set up a plan to sell so many shares right at this specific moment?
And that's it. That is the million-dollar question, isn't it? If the future of this AI company is so incredibly bright, why is the CEO himself cashing out? So where does that leave you, the investor? Well,
you're pretty much stuck right in the middle of this massive dilemma, trying to weigh two completely different sets of evidence and figure out which story is the real one.
This quote just nails it. It really is a tug of war. You've got this incredible, undeniable potential of their AI technology pulling in one direction, and then you've got all these heavy headwinds. The lawsuits, the big tech competitors, the CEO's own stock sales, pulling just as hard in the other direction. And hey, if you're confused, you are not alone. Even Wall Street is basically shrugging its shoulders. The official consensus from analysts is just hold. You know what that really means? It means we have no idea. Their price target points to only a pretty small potential gain, which tells you there's just no strong conviction here, one way or the other.
So how do you even approach this? Well, it really seems to boil down to your time horizon. If you're looking just at the next few months, all that insider selling and market noise, it makes things look pretty bearish. For the medium term, you should probably expect a bumpy ride. It's going to be volatile. But if you're willing to play the long game, you could make the case that their leadership in AI will eventually win out. It's a bullish bet for sure, but one that comes with some serious risks. And that leaves us with this one final, nagging question. Is UiPath an AI leader just shedding some weight to get ready for a steep climb to the top? Or are we watching a captain quietly abandoning a ship he knows is sailing straight into a storm? That, right there, is the UiPath enigma.